Hi, I'm Josh Patinkin, Managing Director of Leste Group. Leste is a multi-strategy asset manager, mostly in the space. So we have real estate, which is what I do. We have credit, real estate credit, and then a bunch of other small lending businesses. We have liquids strategy here, and we also have private equity. So those 4 or 5 business lines make up the diversified asset manager. Overall, we have about $1.5 billion of equity under management, 300 million of which is with real estate equity, and we control around $1 billion of assets in real estate. So the multifamily housing market is an incredibly large asset class and an incredibly liquid, backstopped by federal agency money and has a mandate to keep housing available for Americans. So Fannie Mae, Freddie Mac create a lot of liquidity in the space, and we're seeing that right now. There's a lot of capital that are chasing deals. I would say there's more capital than there are good deals, and it's difficult to find investments. That said, we're finding our fair share at Leste, and there's lots of transaction activity across the country right now. Um, there's not enough homes being built in the country, and the homes that are being built tend to be higher end and targeted for a more affluent renter or a more affluent buyer. And the reason for that is just cost. Cost of goods, cost of labor is high. You need rents that are high in order to make sense of the product that's being delivered. And so we have a housing shortage overall, which is especially difficult or focused in workforce housing or middle income housing. And that's what's characterized the kind of, from an investor standpoint, the favorable supply demand picture. You've got uh, very little supply coming into the market. You have no supply coming into workforce housing, middle income market, and you have demand. You have lots of demand. American population is growing, and then in certain markets, people are moving to Texas, to Florida, to the Southeast. So you have a favorable demand picture and just not enough supply to keep everybody housed comfortably. So COVID-19, big impact on all of us. For real estate, and I think for many trends across the country, it really accelerated trends that were already here. One of those is millennials moving from downtown urban cores out to the suburbs, and we saw that really accelerate. Anybody who was thinking about moving to the suburbs, a lot of us made the decision to do it, um, and we're seeing home prices in the suburbs increase much more so than we're seeing downtown condo prices increase, as an example. Another trend is moving. People moved to the Southeast, to Texas, to Florida, to Arizona, lots of places where maybe there's higher quality of life, more sunshine, more vitamin D. Um, that's taken shape in a bit more of an accelerated fashion than we were seeing it before COVID. And employers want to be in these places because maybe labor is a little cheaper. Employees want to live there because there's jobs coming in, there's growth, and it's better weather, right? It's higher quality of life. Some of the current challenges for multifamily investors, developers, inflation. I mean, inflation is here. It's good news because from a landlord's perspective, you can raise rents, and that's happening all over. It's bad news because it makes your cost of debt a little less predictable and a little bit more expensive. So, as one good example, we're in the market right now to close a multifamily investment tomorrow. And normally we would purchase a derivative that caps our interest rate exposure. and that would cost us like $30,000 for this type of transaction. Well, it's going to cost us about $130,000 because everybody's predicting interest rates are going to rise, so it's more expensive to hedge them. Um, that's one example of inflationary pressure on interest rates and on rental rates, but cost of work is up. To renovate a unit is more expensive. So we're seeing inflation all throughout the system right now. Um, Another challenge that we are seeing in the multifamily development business in particular is just the supply chains are challenged at the moment, and we're managing through that for the most part. Maybe we have Samsung as our washer and dryer spec for a project, and we have to switch it over to GE, right? Because the Samsungs just weren't available. But it's creating a lot of logistics challenges that we're working through for the most part, but occasionally the product just doesn't arrive when it's supposed to. So within the multifamily business, a strategy that we like is workforce or middle income housing all throughout the Southeast. And I'll say middle income housing because there's really no new supply for middle income housing coming into the market. You can't build apartments cheap enough to charge middle income rents, right? So all of the new supply is focused on Class A and higher rents than what we are purchasing. So we've got a favorable supply demand perspective. There's no new supply that's competing with the assets that we're purchasing in the workforce housing business. And every year, an asset or two in a given market maybe becomes obsolete. So you actually have shrinking supply. Meanwhile, demand is only increasing, right, in the places we're investing because people are moving there. There's jobs being added to that economy. And so you've got increasing demand, decreasing supply, and a favorable dynamic for an investor. Um, we like the Southeast for a few reasons. One is jobs are going there, so people are moving there. So household formation is increasing. Um, the other reason is we feel it's just under penetrated relative to some of the bigger markets by institutional investors. So there's more good deals as a percentage of deals on the market. And what I mean is, in a place like Boston or San Francisco, New York, Chicago, it, institutional investors have been in these markets for decades, and much of the multifamily stock has been improved over those decades. Whereas in the Southeast, it's been more of a mom and pop type experience. Maybe there are a little bit more meat on the bone, a little bit more you can do to improve a community, to add value to the residential experience. And that's what we're looking for is we want to create positive communities, a good experience for our residents. And if we can do that more so in a place like Greenville, South Carolina, or Huntsville, Alabama, because there's just more work to do, there's more good assets to improve, that's where we want to invest. To learn more about Leste and some of the investments we're making in multifamily and in other spaces, please click the link below, give us a call. We're happy to talk anytime.